million Australians own crypto. Most of them will get their tax return wrong this year. The ATO now has data matching agreements with every major exchange. They have sent over 350,000 warning letters. And the 2026-27 budget just changed how capital gains are taxed. If you hold crypto in Australia, this video could save you thousands. Let me walk you through what the ATO actually requires and what most people get wrong. The first thing you need to understand is how the ATO classifies crypto. It is not currency. It is property. Specifically, it is a capital gains tax asset. That single classification changes everything about how you report it. There are two categories: investors and traders. Most people, including me, fall into the investor category. You buy, hold, and occasionally sell. Capital gains tax rules apply. If you hold for more than 12 months, you get the 50% CGT discount, at least until July 2027, but we will get to that. Traders are different. If you are trading daily as a business, your gains and losses are treated as ordinary income. The ATO looks at factors like frequency, volume, and whether you treat it as a business. There is also the personal use asset exemption. If you bought crypto under $10,000 specifically to use for personal purchases and you used it within a short time frame, it may be exempt. But the ATO has explicitly warned that holding crypto as an investment and then occasionally spending it does not qualify. The tax year runs from the 1st of July to the 30th of June. Your deadline is the 31st of October 2026 if you self-lodge, or the 15th of May 2027 if you use a tax agent. Let me break down every taxable event the ATO recognizes. There are two categories: capital gains tax events and income tax events. CGT events include selling crypto for Australian dollars. That is the obvious one, but here is where people get caught. Trading one crypto for another is also a CGT event. If you swap SOL for Ethereum, that is a disposal of SOL at its current market value. The ATO treats it as if you sold SOL for cash and then bought Ethereum. Spending crypto on goods or services is a disposal. If you buy a coffee with Bitcoin, you have triggered a CGT event. Depositing into a DeFi liquidity pool is a disposal. Wrapping a token, like converting ETH to wrapped ETH, is a CGT event because you are disposing of one asset and acquiring another. Income tax events are different. Staking rewards are taxed as ordinary income at the fair market value on the date you receive them. Non-initial airdrops are also income. Mining rewards are income. Here is what is not taxed: buying crypto with Australian dollars, simply holding, transferring between your own wallets, receiving coins from an initial allocation airdrop or a hard fork. Let me give you a personal example. When I swap SOL for another token, that is a CGT event. When I receive staking rewards on my holdings, that is income. Both need to be reported. DeFi is where most people get blindsided. The ATO has not published specific DeFi guidance, but the general CGT rules still apply, and they create some unexpected tax events. Wrapping a token triggers a CGT event. When you convert ETH to wrapped ETH, you are disposing of one asset and acquiring a new one. Even though wrapped ETH is meant to represent the same thing, the ATO sees two separate assets. Depositing tokens into a liquidity pool is a disposal. You are exchanging your tokens for LP tokens, a different asset. That is a CGT event at the time of deposit. Yield farming rewards are treated as ordinary income, taxed at your marginal rate when received. This catches a lot of DeFi users off guard. They think they are just parking assets, but every interaction can be a taxable event. For context, I hold EETH, which is an Ethereum ETF on CBOE Australia. That is a simpler tax treatment than direct DeFi participation because ETF gains follow standard CGT rules without the complexity of wrapping, pooling, and yield calculations. If you are active in DeFi, a crypto tax software like Coinly or CoinLedger is almost essential. Manual tracking across protocols is extremely difficult to get right. Now here is the part most people have not caught yet. The 2026-27 federal budget announced a major change to capital gains tax. Starting the 1st of July 2027, the 50% CGT discount is being replaced. In its place, you will get CPI indexation of your cost base, plus a new 30% minimum CGT rate. Let me explain what that actually means. Currently, if you hold an asset for more than 12 months, you automatically get a 50% discount on the capital gain. So if you made a $20,000 gain, you only pay tax on $10,000. Under the new system, instead of a flat 50% discount, your cost base gets adjusted for inflation using CPI. In a low inflation year, say 2%, that adjustment is much smaller than a 50% discount. The 30% minimum means that regardless of your marginal tax rate, you will pay at least 30% on any capital gain. For high earners already paying 45%, this does not change much. But for people in the 30% to 37% brackets, you lose the effective benefit of the 50% discount. This is significant for crypto holders because the 12-month hold strategy was the primary tax optimization tool. Starting July 2027, that strategy becomes less effective. The ATO is not guessing. They know what you hold. Let me walk you through the 5 most common mistakes that trigger an audit. Number 1. Not reporting crypto to crypto trades. This is the most common error. People think only cashing out to Australian dollars is taxable. Wrong. Every trade is a CGT event. Number 2. Ignoring airdrop and staking income. If you receive tokens from staking or a non-initial airdrop, that is accessible income in the year you received it. Number 3. No records. The ATO requires you to keep records for 5 years. Transaction dates, amounts, wallet addresses, exchange records. If you cannot substantiate your cost base, the ATO can deem it as zero, meaning your entire sale proceeds become the capital gain. Number 4. Wash sales. Selling at a loss and immediately rebuying to claim the loss. The ATO has explicitly warned against this and can deny the loss. Number 5. Abusing the personal use asset exemption. Claiming crypto held as investment was for personal use. The ATO sees through this. The ATO has data matching agreements with major Australian exchanges including CoinSpot, SWYFTX, Independent Reserve, and others. They have sent over 350,000 warning letters to Australians whose exchange data does not match their tax returns. They can also track on-chain activity. If you found this useful, subscribe. I cover crypto markets, AI infrastructure, and portfolio strategy every week. I also publish free daily intelligence briefs covering crypto and global equities. Link in the description. Premium research is available at ionchinek.gumroad.com. In video 11, I built a 3-layer crypto portfolio model. Each layer has different tax implications that connect directly to what we covered today. If you are serious about your portfolio, watch that next. Drop a comment. What is the most surprising crypto tax rule you learned today? This is educational content only. It is not financial advice, and it is not tax advice. Consult a qualified tax professional for your specific situation. I hold positions in SOL and EETH as disclosed. AI-assisted visuals and narration used in this video. Thanks for watching. I will see you in the next one.